Now this is a fun case study. I'm sure you guys had your set of enjoyment with this one, and this is as bad as it gets for the final. So no worries. I will walk you through all the steps and you will surely understand everything, I have no doubt, and then you will have no problem to answer the question in the final. So this final prep case study for us is called Journey to Bali. In the first step of this case study, when we look at the assumptions and apply them, we are asked to establish a budget. I have given you a budget template. This is a limited top sheet. Normally this top sheet would have a few more line items, but since we're not a line producing class, I thought it was okay for us to just have a limited top sheet budget here for this case study. So in the assumption listed in the case study, you see the various line item amounts for story and rights, 25,000, writing, 150,000, development, 75,000, the producer and staff, 850,000, the director and staff, 250,000, and talent, 3.5 million. You plug these numbers in and you're going to get to and above the line number of 4,850,000. Next, we have a shooting period or below the line items, the production staff of 500,000, the camera, 250,000, set construction, 25,000, locations, 50,000, and other production period allowances, which includes everything imaginable that is not covered here for your production, $6.2 million. And I kind of summarized it here. Again, this is not a line producing class, so I allowed ourselves to summarize these line items, which are normally a lot more and more specific. So for the shooting period, we end up paying $7,025,000. And then we go into post-production. And here we have some items for the editing and the editing department, $320,000 for the post-production of the film, $260,000 for visual effects, $320,000 for music, budget $120,000 for other post-production allowances, $650,000. Again, normally these would be specified in more line items. So altogether for post-production, we have $1,670,000. Then we have some general expenses and legal fees of $250,000 and some other cost and financing fees of $1,354,500. So all these other accounts come to $1,604,500. If we're summarizing all this, our subtotal would be $30,545,000, and the added contingency and completion bond will get us to a grand total of $16,102,740. The line item budget limited top sheet that I send you in the template summarizes this automatically and also calculates the contingency and the completion bond fee for you automatically, even looking at the various exclusions that are applied here, because there are certain fees that were not being charged our 2% completion bond fee on, which is the rights fee, the writer, the development, the producer and staff, legal. So these line items are actually not subject to the completion bond fee of 2%, and that's already automatically deducted in the temp budget top sheet that I have provided you with. But it is mentioned in the assumptions that the completion bond fee is 2%, the contingency is 5%, and this again is automatically calculated. So if you just plug in the numbers that are provided in the assumptions as they're listed here, these will automatically calculate for you and you will get to a grand total budget of $16,102,740. So in this case, for this movie, we are actually not just selling the film to a US distributor after it's finished, which we have done in many other case studies. Here, we are actually applying a rent a studio deal, which we have learned about in week 2 of our modules. Remember, the rent a studio deal is a deal where you would hire a studio to release your film and you pay the studio to do that work for you. You pay them a distribution fee. A normal distribution fee for a studio can be around 35% and up. The fee for a rent-a-studio deal that the studio would charge you as the distribution fee is usually lower, around 20 to 25% normally. That's why I've seen what I've seen. So in this case, you have to also raise the print and advertising money to then give to the studio so they can do the release work for you, do the campaign work for the movie, and get paid by you through the P&A investment that you have raised with a P&A investor. There are investors in the marketplace that only do P&A release campaign financing for these kind of movies that are being released with studios, where the producer basically rents the services for the studio and the studio does the work, and we as the producer get to enjoy all the deals that the studio have with all the advertisers. And what happened here is we decided together with the studio that our film Journey to Bali is going to be released on 1,500 screens in the US. So that means 1,500 screens, 1,500 theaters in the US will show our film. The major studio that we're renting for the release services is Paramount Pictures. We are working with a P&A investor, and the P&A investor will pay us $1,500 per screen. So $1,500 per screen pays for a certain amount of P&A. In this case, the P&A cost would be $2,250,000 for this release, which by the way is very inexpensive. Normally it's a lot more. But let's say we are making a very defined release campaign, so we're only paying $2,250,000. The P&A investor is charging us a 12.5% fee on that, so altogether we're going to have to pay back $2,531,250. So that's what our P&A is going to cost us. But let's start with what happens in the US. So here we are actually calculating to receive $20 million in box office. So that's basically just tickets sold. So we're selling $20 million worth of box office tickets, regular film tickets. The exhibitor, the theater owner, is also getting money, which is, by the way, also the case when a studio releases a movie. And in our case, we're assuming that the exhibitor, the theater owner, will get a 45% share of this box office revenue. 45% of 20 million is $9 million. So that means that we are left with $11 million right now, and that's what the studio would get. And Paramount Pictures' distribution fee of 25% is deducted from that. So the adjusted revenue for the US right now is $8,250,000 when we start with the box office revenues, right? So again, it's $20 million tickets sold. The theater owner gets 45% of that, which is $9 million, which leaves us with $11 million. The distribution fee we have to pay to Paramount is $2,750,000, which is 25% of $11 million. So right now we're looking at $8,250,000 as revenues from the US. Now our P&A investor has to get paid back, and as we said, they are owed $2,531,250, which leaves us with US revenues of $5,718,750. So let's take a look at our international distribution revenues. So here, again, we are looking at our sales estimates first, and then we're looking at what our pre-sales are. So first we say, okay, we have 80% of our budget that we believe we can make from international distribution rights revenues. So 80% of 16,102,740, which is our budget, would be 12,882,192. So that's our projected revenues from the international marketplace. Now of that, we are now deducting pre-sales, because we're going now out into the film market and we're selling certain international territories for certain countries to certain distributors. And in our case, we're selling two kinds of territories, if you want. The Tier 1 territories, which include Germany, Italy, the UK, and France, and the Tier 2 territories, which is India and China. Tier 1 territories are territories that the bank values as a higher value territory. They're more reliable in the eyes of the bank. They're less risky. Tier 2 territories are territories where a bank will say, we have potential issues with these territories, or we had issues in the past. We see them as more risky, which will later translate in the bank loan and in the bank saying we're only going to cash flow a certain amount of those contractual numbers of the license fees for the Tier 2 territories. So Tier 1 territories, the bank will look at these contracts and normally give us a higher amount, and Tier 2 we get a lower amount in pre-sale loans. So here, let's look at our territories. The Tier 1 territories we have sold. We have sold to a German distributor for 10% of the budget. 10% of 16,102,740 is 1,610,274. The down payment that the German distributor makes the moment we are signing the distribution agreement with them is 20% of that license fee. 20% of 1,610,274 is 322,054 and 80 cents. We're having cents here even. We're going to be very specific. So yes, which basically means the distributor says, I'm going to buy Germany, I'm going to give you 10% of the budget, I'm going to pay 20% right now when I'm buying this, and I'm going to give you 80% when you're delivering the movie to me. The same goes for the other distributors. The Italian distributor is going to give us 70% of the budget, 7, not 70, so 7% for Italy is 1,127,191,080 cents. So that is 7% of 16,102,740. And their down payment, the Italian distributor only pays 15% as a down payment. That is 15% of 1,127,191 and 80 cents. So that is 169,078 and 77 cents. The UK distributor gives us 8% of our budget, which is 1,228,219 and 20 cents. And the down payment they are paying for us on signing of the distribution agreement is 20%. 20% of 1,288,219 and 20 cents is 257,643 and 84 cents. The French distributor gives us 9% of the budget, 1,449,246 and 60 cents. 20% down payment is 289,842 and 32 cents. So altogether, from our Tier 1 territories, we have earned pre-sales in the value of 5,474,931,060 cents for license fees. And of these license fees, we are now receiving on signing of those deals 1,038,626 and 73. Now the Tier 2 territories, India and China, each give us 0.5% of our budget and each have a down payment of 10%. So altogether for Tier 2, we get 161,027 and 40 cents, and the down payment here is 102 and 74 cents. So altogether, Tier 1 and Tier 2 license fees come to 5,635,959, and altogether our down payment amount is 1,054,729 and 47 cents. This is what we would be receiving at this time from these pre-sale agreements. Now the sales agent who made these pre-sale agreements happen is now charging a sales fee of 6% on that amount. So that is 63,283.77. So available to us at this time to cover our budget is 991,440 $445.70. So let's take a look at the bank loan. We're using the bank for two things. We are looking to get a loan against the pre-sale agreements that we've just talked about. We're also looking at the bank to give us a loan against the rights we can still sell when the movie is finished, which are the unsold rights. So first, remember, we have a pre-sale loan altogether from our pre-sales, which we have established earlier for Tier 1 and Tier 2 territories. Altogether, we have received there $5,635,959. Now, the bank doesn't give us the entire amount because the bank says, I'm looking at your Tier 1 territory and I'm looking at your Tier 2 territory, and I'm only going to give you a certain percentage of that amount. So for the Tier 1 territories, which we have totaled $5,474,931.60 earlier, of that we only get 93%. So what we're getting for the Tier 1 territory is $5,091,686.39. And the loan we would be getting for the Tier 2 territories is 60% of the Tier 2 territories. And when you remember, the Tier 2 territories were $161,027.40. 60% of that is $96,616.44. So altogether, the bank would look at a pre-sale loan of $5,188,302.83. However, they do know that these distributors already gave us a down payment, a partial payment on these contracts that the bank is cash flowing for us. So the bank knows we will receive that money, so it will not lend us that portion. So we have to deduct the down payment of $1,054,729.47. So that will be deducted, and we have to deduct the gross amount here. Even though we are paying the sales agent their 6% from this amount, the bank doesn't care about that. The bank says you received from these pre-sale contracts a down payment. I am deducting the entire down payment from your loan amount. That is why they're deducting $1,054,729.47, leaving us with a pre-sale loan of $4,133,573.36. Now this loan is the loan amount we will have to pay back, but remember we have to pay interest, and the interest we have to pay is 4% per year, and for 2 years it is 8%. So the 2-year interest reserve on the pre-sale loan amount of $4,133,573.36 is $330,685.87. So our net pre-sale loan from our pre-sale agreements that we will be getting and can use to cover a portion of our budget is $3,802,887.49. So now the second version is we have to figure out what our gap loan will look like. And here we have to obviously look at what are actually our pre-sales and what are our sales estimates altogether. So when we look at the entire sales estimates, we are looking at our 80% of the budget number, which is $12,882,192. That was 80% of the budget. Those were the entire international sales as projected. From that number now, we're deducting our pre-sales. We're deducting each territory: Germany, Italy, the UK, France, India, China. These are defined pre-sales that we are now deducting. And when we're deducting every country that we have pre-sold, we are left with unsold territories in the value of $7,246,233. So the bank will look at that value and says, that's great, but I'm only giving you a loan of 50% of that. And by the way, I will never give you more than 20% of the budget. So we have to figure out, A, what is 50% of 7,246,233, and that is 3,623,116.50 Now the budget cap would be 20% of the budget. Now what's 20% of the budget in our case? Looking at our budget, which is 16,102,740, we are therefore looking at the cap of 3,220,548. That is our cap, and that is the only amount, and that is the highest amount the bank will give us as a gap loan. So we're putting that in. That's our gross gap loan. That is 3,220,548. The bank will charge us 60% for the 12% together for the 2-year term. I'm just seeing a spelling here. I'm going to fix that later. So 6% per year for 2 years comes to 12%. So here we are at 386,465.76. So that's the interest that we have to pay on the gap loan. So net would be 2,834,082.24. Then we have a loan fee of 65%, we have a legal fee of 25%, and that's 90,000. So we have to also deduct those fees. So net, we are going to have a loan available to us to cover the production of 6,546,969.73, and the gross loan amount that we have to pay back the bank is 7,354,121.36. So those are the numbers to remember when we say a gross loan, because that is the number that we have to pay back, and the net loan amount is what we will have available to cover our budget with. So next we have to calculate our junior loan, also referred to as a mezzanine loan. So here the terms and fees include the following. This lender will give us 15% of the actual production costs that need to be financed. And they want a 10% premium on their money. They want 5% interest that is paid up front. They have a 5% back at profit participation, and they also get 75% producer fees payable deferred behind the premium. So the premium of 10% and the producer fees are going to be dealt with in the recoupment, but the interest is going to be paid up front, which is why we're dealing with it here. However, let's jump back to our budget for a moment. I'm going to remind you that our budget was 16,102,740. But of that budget, we have to deal with a strike price component. And that means that we have to look at the in-kind services that were mentioned in the assumption. And those were the visual effects and the music budget. The visual effects amount was $320,000. The music was $120,000. So altogether, these in-kind services were $440,000. We're going to talk about that assumption in a minute. But here, because the junior loan term says I want 15% of the production costs that I actually needed to be financed, which is the strike price, because these in-kind services for visual effects and music, we don't have to pay. They're being deferred. They are only paying on the strike price portion. So if I take those in-kind services totaling $440,000 and I deduct those from the budget, which was $16,102,740, I get to a strike price of $15,662,740. And that is what this junior lender will pay 15% off. Crowdfunding, brand integration comes next, but crowdfunding right now is very simple. We are told we get 5% of the budget financed by a crowdfunding site, which is $805,137. We are told that we have to pay a 25% commission on that, which is $201,282.25. We also used some development funding already. So at this time and at this stage of the movie, we only have, we're going to deduct the $20,000 that we already used as we're putting the picture together. So for the budget right now, as we're putting it together, we have $583,852.75 available to cover the portion of the budget. So later on, we're going to deal with the 1% back-end profit participation that this crowdfunder is requiring. But in general, this funding, or this crowdfunding, I should say, is non-refundable for us, so we don't have to pay this back. So here we are now with brand integration. It's pretty straightforward. We have a brand that offers a sponsorship amount for the movie of $650,000 through a brand that they would like to integrate in the film. The advertising agency that arranged for this deal with the brand is charging us a 25% fee for their work. The brand allows us to use 50% of the sponsorship for the funding of the movie and will then pay the balance when the movie is finished. That means right now we have $243,750 available to cover a portion of the budget. And we will be receiving $243,750 once the movie is finished, and that will then be part of our recoupment schedule. So next in line is the loan that we would be receiving for the production incentives that we can generate in the production location that we're shooting. The production location that we're shooting in will only give us money on the below the line portion of our budget. So only below the line expenses will be supported in this region. And there is a regulation that requires 35% of the below the line as an eligible expense to be accepted. 35% of the below the line portion, which is $8,695,000, is $3,043,250. The lender that will advance this loan for us, because remember, normally we would not get this incentive until the movie is finished, and we would connect with the incentive region and the related authorities, show them all our expenses. So we wouldn't really get the money after the movie is finished. Since we want to use this money now in order to cover a portion of our budget, we're using a lender to advance us this incentive amount. And the lender charges us 10% of the loan amount. 10% of $3,043,250 is $304,325. They're also charging us a legal fee of 15%, which we then also deduct. So we're left with $2,723,925 for the incentive amount that we can use in our finance plan to cover a portion of our budget. So I mentioned the in-kind services slash deferments earlier. So in this case, for Journey to Bali, we have the visual effect line item of $320,000 and the music budget line item of $120,000, totaling $440,000 in deferments as in-kind services. So here, it's not a music investment. It is not something we don't have to pay back related to music here. We have dealt with the music line item before as an investment. We dealt with an investor who gave us money for the music budget and we didn't have to pay that back. And they were recouping against music royalties. We didn't do that deal here. We basically just had a music budget line item that is being deferred and the visual effect line item that is being deferred. So these are service providers who agree to defer their fee until we are getting the movie into recoupment and making money with it, which means at this time we don't have to pay these line items. And that's why this $440,000 is being deducted from our budget, because we don't have to pay this right now. But we do have to pay it later in the recoupment phase because these people do want to get paid. And they're then asking us to pay them a 10% premium on top of the money that they have deferred. So we're going to see later in the recoupment that we're paying them back $440,000 plus a 10% premium. So this $440,000 is the source that reduces our budget to the strike price. And the deal we have with the investor that gives us the equity is pretty simple. They agree to give us whatever is needed as a balance to hit our strike price. So here we are calculating all our finance sources together. They come to $13,321,883.63. In order to hit the strike price of $15,662,740, the investor has to pay $2,300,000 $340,856.37. So let's look at our entire finance plan one more time. We're seeing here the budget of $16,102,740,000. We're seeing the strike price as $15,662,740, simply because the earlier mentioned deferments of $440,000 are not payable at the time of production and are therefore reduced. The international sales estimates and projections are driven, though, by the full budget, because at some point we have to pay the deferments, so that there are a cost, and that is why we as a producer always will use the full budget to project our sales estimates. So 80% of $16,102,740 is $12,882,192. That's our estimated sales. So then we go ahead and start pre-selling our movie. We're pre-selling it to a German distributor, an Italian distributor, a UK distributor, a French distributor, an Indian distributor, and a Chinese distributor. Altogether, we are pre-selling our movies for $5,635,959. The down payment that is paid by these distributors at the moment we are signing these pre-sale distribution agreements with them is $1,054,729,047. The sales agent who generated these pre-sale agreements is asking us to pay him 6% for this work. So we are charged $63,283.77 as a sales fee, which leaves us with $991,445.70 available for funding. So the bank loan looks at our various pre-sales and applies discounting for tier 1, 93%, for tier 2, 60%. So that's all we're getting. And then they're deducting the down payment, of course, because we received this portion from the distributors already. They're applying an interest. So altogether, our net pre-sale loan after all this is said and done is $8,802,887.49. And as mentioned before, we take our international sales estimates of $12,882,192. We're deducting all the pre-sales for tier 1 and tier 2 and arriving at unsold territories, rights we can still sell, in the value of $7,246,233. The bank, however, will only give us a maximum of 20% of the budget. 20% of $16,102,740 is $3,220,548, and that's all we're getting as a gross loan. When we're deducting the interest from that, we are left with a net gap loan of $2,834,82.24. We're then also having to pay a loan fee and a legal fee, so our net loan amount is $6,546,969.73 available for us to be spending on our film budget. So let's review the other finance sources that we talked about earlier. We had a mezzanine lender giving us 15% of our strike price. And remember, the strike price is $15,662,740. 15% of that is $2,349,411. We're paying a 5% interest, and we're left with $2,231,940 available to fund a portion of our budget. The crowdfunding amount was 5% of the budget. That is $805,137. We have to pay the commission. We're also deducting the development fee that we have already used. So we're left with $583,852.75 for our film budget. Brand integration was $650,000, but they're only giving us 50% at this time. And we, of course, have to pay the agency. So right now, for this budget, we get $243,750. The production incentive is driven by the below-the-line portion of the budget only. And we have to pay a 10% fee and legal fees of $15,000. So we're left with $2,723,925 of the 35% production incentive in relation to the below the line. The in-kind services of $320,000 for visual effects and $120,000 for the music budget line item is $440,000. Those are being deferred. We are not paying them right now, so there's nothing to be done here. We're not calculating them when we are creating our subtotal. We're also not using them as a portion of the budget to be covered because we're not covering them right now. So the subtotal with all the finance elements that we have so far generated is $13,321,883.63, leaving an equity investor to give us $2,340,856.37, so we can hit our strike price of $15,662,740. So the movie is finished, we produced it, and now we're getting to a point where we can earn money with the movie. It's being released and it's being sold in the international marketplace, and it's released in the US. So internationally, we have established that we are receiving $12,882,192 from international sales. The down payment that we have used to cover a portion of our budget is going to be deducted from that, because we're not getting that again. So that's $1,054,729.47. So from the international territories, we are looking at $11,827,462.53. Now the US box office is a little different. Here we're not getting license fees as we're getting from the international sales and distributors. Here we're actually taking the movie into the theater. So here we're actually driven by box office risk this time. But we're doing well. We're doing 20 million in box office, so that's not bad. We're paying the exhibitor 45% of our $20 million box office revenues. So we're left with $11 million. And Paramount is charging us a 25% distribution fee. So we are left with $8,250,000 from the US. We then have to pay the P&A investor back, who gave us $2,250,000 and would like to make 12.5% on their money, which is $281,250. So P&A is costing us $2,531,250. So the net revenues that we are left with from the US, after we paid the P&A, after we paid the studio, after we paid the exhibitor, and after we paid all the fees we're supposed to be paying in the US, is $5,718,750. Now, if I add the $5,718,750 to my international sales of $11,827,462.53, I get to worldwide distribution revenues of $17,564,212.53. Now, remember, we still have sponsorship monies to receive, the second payment that is due to us here of $243,750. Now, with that and our worldwide distribution revenues, we have total revenues on our film Journey to Bali of $17,789,962.53. Now, from these revenues, we have to pay a few expenses. So we're paying the setup fee for the collection agent of $40,000. This is for them to create the karma agreement, and this is for them to also work on a film and make all the payments, to set up the accounts and so forth. They usually charge around $40,000. At least they did it for this film. So normally this could be less, just so you know. They're not always charging $40,000. It could be as low as $5,000. It depends on, you know, your film and how much work is to be done. In our situation here, we are assuming that we have to pay $40,000. So that's that. But we also have to pay 1% of what hits the collection account. And remember earlier, our total revenues were $17,789,962.53. So 1% of that is $177,899.63. So that's paid to the collection agent. Altogether, the collection agent gets $217,899.63. And then the bank loan, including loan fees and legal fees and all the interest, and there is a spelling there, I apologize. I'll fix it in the Excel sheet, no worries. But what we're paying the bank now, including all the fees, is $7,354,121.36. That corresponds with the gross loan amount that we had established earlier. We are making this movie with SAC, WGA, and DGA, and they are paid a guilt fee, guilt residuals here of $850,000. As we learned in the guilt residual module, this is something that you can discuss with the guilds early on to get an estimate of what this number would be. So you would tell them, this is the kind of movie I have, this is the sales estimates and this sales and distribution I am foreseeing. Can you give me an estimate? And normally they'll give you an estimate about residuals that you can expect. So in this case, we're paying $850,000 to them. The sales agent is charging us 16% in sales fees. And remember, the 16% are charged on the unsold rights only because we already paid some of the pre-sales. And the sales agent deferred 6% of the pre-sales to be paid later. So we are going to be paying a 6% fee that is charged on the sales minus the down payment. So here we are charging 16% on the unsold rights, which is $1,159,397.28, and then 6% charged on pre-sales minus the down payment is $274,873.77. So altogether, the sales agent will receive $1,434,271.05. The mezzanine lender, who gave us $2,349,411, wants obviously to get that money back, but also is asking for a 10% premium and a deferred producer fee. So now we're paying all this. So altogether we're paying $2,349,411 for the mezzanine loan, also referred to as a junior loan. 10% of that is $234,941.10 plus $75,000 producer fee. Altogether, the junior lender, mezzanine lender, is receiving $2,659,352.10. The equity is next. The equity investor gave us $2,340,856.37. The premium of that amount is $468,171.27. Altogether, Altogether, we are paying the equity investor $2,809,27.64. So now next year we are paying back our $440,000 deferment from the visual effects and the music that we earlier took out of the budget. 10% premium of that is $44,000. So here are $484,000 that we're paying for in-kind services. Altogether, our expenses are $15,808,671.78. So if we take all our revenues, which were $17,789,962.53, and we're deducting all expenses, which were $15,808,671.78, we are left with net revenues of $1,981,290.75. So now we have a few people that have contractual obligations with us that we need to pay. The mezzanine lender was requiring a 5% back-end profit participation. The crowdfunder was requesting 1% back-end profit participation. Talent pool, which is the cast, the director, have 30% of our net profits to receive. And the equity in this case is not getting its usual 50% of whatever they invested in the movie in relation to the budget. They actually requested a 40% back-end profit participation as a contractual item, which we agreed to. So altogether, we have to pay 76% in profit participations to all these various parties. So the junior lender has $99,064.54 to receive. The crowdfunder receives $19,812.91. The talent receives $594,387.23. The equity receives $792,516.30. So altogether, we're paying these people $1,505,780.97, leaving us the producer with 475,509 and 78 cents. And that is the answer to your question. The question was, how much is producer profits? Producer profits is 475,509. So this was a fairly complex case study, which is something that you will likely be facing actually out there in the world as you put your movie together with all the various finance sources you have learned about. The deals obviously might be different, the terms might be a little different, but they are likely similar to what you're seeing here. So this is something that you can remember when you start working on your own projects, and it's definitely going to be helpful to you when you're going to answer the question in the final. Now, as always, if you have any questions about this case study, you can feel free to contact me via Canvas, and I'm happy to set a one-on-one Zoom session with you and walk you through this case study step by step again. So no worries on that. Always feel free to reach out. I am here to answer all your questions. Have a lovely day.